G'day everybody, hope you're well. Craig here from the Grammy Co. You know that because you're in my mailing list. Welcome to all the new participants in here. This week we are not doing a live market analysis. I do that most weeks. It's an educational piece this week for the main reason, when you receive this, I'll be in the, Scottish Highlands. I'll be in the Victorian High Country with my kids having an epic adventure. And I mean, that's really what it's all about, isn't it? You know what I mean? Like, I'm going to be out there creating memories for us for the rest of our lives. And right now, I'll be having an absolutely ripper time. Anyway, I wanted to come in and talk to you about risk management, giving you some tools, whether or not you've gone through my complete course or whether or not you're just starting out and you're just trying to learn along the way. Risk management, it's the core of all trading. It really is, because you're going to run into some hurdles as a trader. It's going to be hard at times. One of the things that I don't want to be hard for you, and what you don't want to be hard for you, is your ability to stick with it. Having grit is not about taking massive gambles and repeating that process. Having grit is about having a systemized approach, and then your job is to get really good at that system. Okay, it's the same with anything. You know, if you're a pilot, just because you know how to fly a plane doesn't make you, an expert pilot. You know, you've got to understand what it is you're doing, and you've got to apply that yourself to own it as your own. And it begins with risk management. It is the core of all trading. Risk comes in many different forms. And, there's so many modules within the full course that covers it, from what profits do you take? What targets do you have? How much do you risk? When do you take away yourself from the market? I'll touch on that in just a moment. So anyway, educational piece for you all, incredibly important. The key to trading is risk and money management. And we've got reward and we've got risk ratios. We've got to understand what a good trader does. And you've got to understand as well, one of the important things to really, hone in on is you don't want to be a gambler. And when we think of gambling, we think of playing the pokies or being at the casino and playing blackjack or gambling on poker or whatever. There's many different ways that we can gamble, of course. What you don't want to be in trading is that. You don't want to be a gambler. And that, again, comes down to our systematic approach, our disciplined approach, and the way that we go to the market. We ask the market, are you ready for us? Do you have what I need? As opposed to, I'm going to find something to make money on. The shift from focusing on profits to focusing on structure, discipline, and fulfilling your objective with your strategy is very, very different. See, the mindset shifts. Experienced and profitable traders will focus on one thing and one thing only. It's not one thing and one thing only. It's two things. It's risk. It's how they approach the market, so their strategies, and then it's risk, how they decide how much they're going to place on the trade. And that decision is based on capital preservation first. You see, when we're gambling, we're thinking of how much money we can make. When we're trading, we're thinking, what have we got to lose? How much am I going to risk? And then what am I looking for? The profit side of it, you've got no control over. It's not up to you if a trade is going to play out in your favor and be profitable, a little profit, or a big profit, or a break-even trade. You have no control over that. What you have control of is your strategy, the way you approach the market, and how much you risk on your trade. So your focus needs to be on that risk. Now, a lot of the questions that come up, which are natural, where do I take my profits? When should I move my stop loss? And why do we take a 1-to-1 first target and not 4-to-1? All of which I'll cover in brief within this video, in detail in the course. Asking the questions is really, really important. You're going to shift and develop over time. Remember, you've just got to get started. You don't have to be started. So you don't have to be great to get started, but you have to get started to be great. And you'll be taking screenshots so that you'll be able to know the answer, as opposed to going, oh, geez, I've had a couple of good winners. I'm going to now not take 1-to-1. I'm going to aim for 3-to-1. Don't let that thinking get in the way of good execution. And what I mean by that is you're taking screenshots of your trade. You'll have a data set. Go through that data set and work out, where is my highest probability of the best outcome. So you might be getting a number of trades that are hitting 2-to-1, 3-to-1, and you're scaling them all out at 1-to-1. Well, with the data that you now have over your last 10, 20 trades, you can work out, you know what, over those trades, if I'd have taken my first target at 1.5 reward to risk to 1, which is 1.5 times the amount, so $100 risk would be 150 profit. Then you can start to, so that would be 300 profit. Let me break it down in some visuals in a minute so I don't confuse you anyway. You use the data, essentially you use the data to work out what's going to be best for the way that you trade. Because remember, I'm not trying to create mini me's in trading and teaching you to trade. I'm trying to teach you some structure and strategy that you then master and then you become the owner of for your future. If you focus on risk, you are focused on keeping the money that you have, and that is the most important thing, because when you have no money, you cannot trade any longer. Now, one thing you need to understand with risk is that you must first accept it. It's not going anywhere. And look, that, I'll suggest that spans into all aspects of life. There is risk in everything we do. And of course, when we get in the car, well, first of all, we buy a car that we hope is relatively safe. Secondly, we put our seatbelt on. We have these mirrors all over the place. We have all these sensors all over the place. What are they for? They're for increased safety. They're managing the risk associated with being in a motor vehicle. Well, in trading, and we accept the risk when we get in the car, right? In trading, we must accept that risk first. Every trade you take, you are taking a risk. You may lose money on that trade. To avoid risk is to avoid trading altogether. To avoid risk is to live in a shell. To avoid risk is to have no reward. You must not avoid risk. You must reduce your risk and transfer that risk then into your profits. The reason that we're doing this is to take whatever it is we're risking and try and multiply that level of risk into our reward, and to do that on a consistent basis so that we can yield profits from that and become successful, consistent traders. Now, there's a great quote here from Paul Tudor Jones, which comes out of the book, I think it's the New Trading Wizards, or it might just be the Trading Wizards. Great books, by the way. New Trading Wizards and Trading Wizards, really good books on really great traders. What Paul says that I really like is, I'm always thinking about losing money as opposed to making money. Don't focus on making money. Focus on protecting what you have. And if you think about your own life, you're probably doing that in many different ways anyway. A lot of people are scared of, investing into crypto as an example, because, well, I'm paying off my mortgage, I've got this, I've got that. I don't want to lose that. So you understand the feeling of, I'm going to keep what I've got. Well, keep that and apply it into your trading. Keeping what you have is so important. If you're not risk managing properly, I suggest 1%, by the way. The reason 1% is that we can have a number of losses, still be in the game. Those losses, if we're doing the right thing and taking our screenshots and having a real good look against our checklist systems to see if we're doing the right thing, well, the information will become available. It will become evident if you are, in fact, making mistakes and exactly where those mistakes are coming in. In other words, if you can, if you can capture it, you can measure it. If you can measure it, you can manage it. That's what I'm trying to say. The only way you can measure it is by capturing those screenshots. Again, the course will cover all of that. 1% per risk is so important. That means that if you've got a $5,000 trading account, you're risking $50 per trade. It's not enough money to really hurt, but it's enough money that there's a tangible amount there that you don't want to lose. So you're going to be more stringent when it comes to your application of the rules, okay? We're going to make better decisions when we're focusing on keeping the money we have and only looking to move that into profit. That's what we're looking to do, okay? Here's something that not enough people talk about. Is something that not enough people prepare for. And I respect the optimism of a new trader. I respect the optimism of anyone getting into the market. But the reality is you need to have what I call a parachute plan. A parachute plan is when you jump out of a plane. If you don't have a parachute, you're dead. If you have a parachute, well, at least you've got a fairly high probability of floating down to the ground and being able to jump another day. Now, in this case, what I've got here is a bit of a breakdown. I'm showing you what I use. Now, what I use doesn't necessarily need to be what you use. It's what you're comfortable with. What you need to do is you need to have a point at which you stop trading and walk away. You do a review of your screenshots. You see if you're making mistakes, because look, you're going to have periods in time where, you might take 3 or 4 losers right in the nose. You have a look at those trades and you go against this checklist and you go, you know what, I haven't done anything wrong there. There's no mistakes there. I've executed all of those trades flawlessly to the level, to the strategy checklists. There's nothing I need to change, but just in the act of doing that, you are able to remove yourself from the market, do some reflection, take some accountability. And in this case, what I just gave, it's all good. The market is the market. It's not going to give you, 2 winners to every 1 loss. It's going to throw you spanners in the works. You're going to have periods in time where you do nothing wrong. The market just shits on you, and that's okay. There's also going to be times where you go through and when you hit your daily loss of 2%, let's say, you go and you do a trade review and you go, ooh, yeah, right. There was divergence on that next high time frame. And for some reason, whatever reason it was, I decided against seeing that. The strategy says I can't do that, but I did it anyway. Okay, well, I'll regather my thoughts and I'll go back into it and I'll make sure I don't forget that. These are the things that we need to do. Once again, accountability, owning what you've done. The only way you can have accountability is by first recognizing where the mistakes are being made. So I've got a daily loss, a weekly loss, and a monthly loss. If my daily loss is 2%, well, I am stopping. All right. Now that could be 2 trades at 1%. Bang, bang, 2 out. It could be 4 trades at 0.5%. However you skin that cat is up to you. Now you know how much you have to risk per day. In a week, if I'm down 3%, I stop, I walk away. It doesn't matter if it's a Tuesday. If I've got the rest of the week ahead of me, I will not start trading until the following Monday. It is a rule that I set in stone because I need a break from the market and I just have to give myself that time. It is super strict for me and I will walk away. 5% a month, I am out for the month. If that is the beginning of the month, once again, it would be obviously only in the second week, provided I'm sticking to the rules that I have here. If it's 5% in a month, well, if it's 2 weeks into the month and I'm down 5% in my second week, I'm out. I'm out for the month. And that's it. Full trade review, showing my trades, looking at my trades. If you've got a mentor, showing the trades to your mentor, provided your mentor or the people around you know what it is that you're trading. The Discord community is really great for that, is to have some reflection and to get some help from myself and other people. So you have to have that cutoff point. Whatever it is for you, make sure you've got it. This is all part of your business. Trading is a business. We have plans around how much we risk per trade. We have plans around how much we how much we are down as to when we pull out, and then what we do to bring ourselves back to it. You see, trading is not the sort of business where more work equals, let's just power through it, let's just find a solution. In an entrepreneurial world, that I live within, sometimes more time working things out can yield the result you're after, because sometimes it just takes more time to fix the problem. In trading, it's not usually like that if you have a very strict and straightforward plan. It's usually take some time, do your review, get back to a good level playing field. Don't let the energy be up. Your emotions, don't let them be there. If your emotions are there, you've got to stay out until they're gone. And this plan helps you to put yourself into that position where you can do that with a strict set of rules. Now, you've got trade risk and reward. You've got a stop loss, which will dictate your reward to risk ratio on trades. And the way that I go about things is by having 1-to-1. Now, this is very, very good for anybody who's starting out. I suggest that everybody who is beginning as a trader sticks with 1-to-1 to start. Why? Well, because you have not got the data yet to suggest what might be your sweet spot of taking your profits. The other thing is, let's use the example here of trading on a $20,000 account. You're risking $200 every trade for your 1%. So if the trade stops you out, you lose $200. In this particular example, we've got an entry at $6,500 and your stop loss is at $6,100. That is now your trade risk. The trade risk, so-called trade risk, is the distance between your entry and your stop loss, the point at which you will get in and the point at which you'll be taken out. All right? That's your trade risk. Now, to achieve 1-to-1, to make this very straightforward, to achieve 1-to-1, if the trade risk is 400, the distance between your entry and your stop, a 1-to-1 target, so that is a multiple of 1 of risk. 1 equals risk, which is 400. The other one will be reward, which is 1, 400, the same, they're matched off. That would mean that the price needs to move 400 up, in this case it's a long, for you to hit 1-to-1. At that stage, you sell half of your position. So you scale out half of it. You set your limit orders in place to do that. Now you don't need to be at the computer. You've now banked $100 in profit. You've risked 200 on the trade, remember. You've banked 100 in profit. If the price now falls back to your stop loss, you've lost 100 there. You've banked 100 there. You are now break even. And break even is a great place to be, because break even is the place that you become before you become consistently profitable. Let me show it to you in a visual sense. So you can see down here, here is my entry price, all right? That is my entry price right here. That is my stop loss. The red section indicates the 1 of risk. Okay, so that is my risk multiple captured in the red. 1-to-1 profit is now added to the top. You can see this. The price now needs to move to this level, and then my order will be filled and I will bank that $100 profit. Then if price goes and falls back down to here, well, I will have banked $100, I will have lost $100, I am now break even. There's a lot more in the course on this, of course, as well as how to manage, adding a little bit to all the fees, all that sort of stuff. But 1-to-1 as a visual representation is now here on the chart for you. Now, what about this? That's when you scale out, you'll now break even. You have no risk on the trade anymore. Then it can start to move and you trail your stop. And we'll cover that on the course as well. Now, 2-to-1. In this particular example, the price keeps on moving. If you've set a 2-to-1 target, okay, well, you've risked $200. Now it's moved double your risk multiple, 2-to-1. Your profit is now 400. That's looking pretty good right now, isn't it? Oh, of course it is. Well, now we've got 3-to-1. So we've risked 200. 3-to-1 is now, sorry, I've got 3-to-1 visualized, but I'm using 4-to-1 here as an example. My mistake. Little typo over here. Sorry about that. So if you're going 4-to-1, your $200 now is now $800, right? So how do we choose what to do? And that's the question. How do we choose? We can have bigger targets. Yeah, sure. It means that we're going to profit bigger on those trades that allow for those types of moves. Now, you've got to remember that in a strong bull market or a strong bear market, you're going to get some big runners. You're going to get some big moves. But there's also a lot of periods in between where you're not in a ripping market up or a ripping market down. And these times take up most of the time. What's smart is to be able to manage your risk appropriately on every trade. And this is why I recommend taking your risk off the table by taking your first target, 50% of your position, at 1-to-1. Why? Well, now you're risk-free. Your job is now to get 1-to-1. After 1-to-1, don't forget, it can still move 4-to-1. It just means that you've got half the position size. So if it's 4-to-1 now, that second position is now 400, not 800, but you've also banked the 100 in taking that profit. So now it's 500, not 800. So the profit margin won't be as large when you scale out. But you won't have as many losses as well. You'll enter the realms of many break-even trades because 1-to-1 will be hit and then maybe you'll get stopped out. Being break-even is a damn sight better than getting 1-to-1, not taking it, and getting stopped out a full percent. Now, this is the reason I suggest traders start with 1-to-1 and trail their stop thereafter, because it gives them a place where they can be calm, collected, they've got risk-free positions available and they're open. And when you're risk-free in a trade, it opens you up to be finding other trades without having that additional, oh shit, I'm risking this much, oh, I'm not there yet, you know what I mean? It keeps you cool, calm, collected, and allows you to operate as a professional trader as opposed to an emotional human, okay? Now, 4-to-1 is great, 5-to-1 is great. These are great opportunities. These are great things when they happen. You can still take advantage of these big moves whilst managing your downside along the way. And you get a big enough sample set of data from your own trading, and then you can start to tweak those numbers to decide what fits best for you. Anyway, guys, there is obviously a lot more there on the GrowMeCo website. Go and join the course if that's what you desire to do. Join the Discord. I can't wait to speak to you next week when I will be covering the market again. Have a great day. Bye for now.